What do you make of it so far?
Well, I think it was the only credible decision that the RBA really could have made after last week's action in the bond market. I don't think that they could have come out today and not gotten rid of that yield target of 0.1% on the April 2024 bond. And I think that the statement is very much in line with the RBA still saying that it's going to be patient on raising interest rates. So clearly a sign to the market that the central bank thinks the market's gone too far in terms of market pricing. I mean, within the next year, the market's pricing in about 3.5 rate hikes from here. I personally think that that's too aggressive as well, but that tends to be what the market does, that it either starts pricing in too many rate cuts or too many rate hikes at different points in the cycle.
So they're still saying a rate rise is a long way off, as you just mentioned there. We had a 2024 year penciled in. Does this move the dial in any way?
I think from their forecast that they're likely to publish on Friday in the statement on monetary policy, they will have to revise up their short-term inflation forecast for the next maybe to 18 months or so. And that's just on the basis of the fact that we've had this huge increase in durable goods prices across the world from all the supply chain issues that are very well known, high energy prices as well. So the central bank will, of course, have to respond to that like the market has and like economists have as well. And maybe there'll be some near-term upward revisions as well to their growth forecast for Australia, because the reopening in New South Wales and Victoria has gone better than expected when we think a few months ago to the beginning of the Delta outbreak. Both of those economies are in a much stronger position. But I don't think that the central bank is in any rush to raise interest rates. We at AMP Capital think that that the central bank will have to start hiking rates at the end of next year. But clearly the central bank don't think that the conditions are warranted for any hikes within the next year, I'd say.
He was talking a bit about the wage pressures as well. Wage price index increasing 3% over 2023, 2.5% over 2022. Where do you see the trajectory of inflation now? Are you thinking that wage pressures are going to be less subdued? And where does that leave the RBA maybe in the next coming months or years when it comes to pricing in those rate hikes, as you mentioned?
Well, Australian wages haven't responded as fast as you've seen in the US economy. For example, in the US, you've had both inflation and wage pressures. But in Australia, you've only really seen inflation coming through. Wage pressures are still very much subdued. As Kathleen was saying, only running about 2% per annum at the moment, and the RBA wants to see close to 3%. I think the risk for wages is still maybe even to the downside a little bit. The risk here is really when you start to see an inflow of migrants coming back into Australia because we've had closed borders, you might actually see some downward pressure on wages in the short term. Maybe the next 12 months, as the inflation story starts to get more weight and it starts to become more apparent in the economy, I think that there will be more of this wage inflation spiral, but there are no indicators to say that wage growth is going to get out of control in Australia, not like it is in the US, where you're seeing very strong wages growth across all income quintiles, really.
So they're pushed back when it comes to rate hikes, but at least they have scrapped that yield curve target. Would you say this is a significant U-turn from the RBA or a significant policy shift?
I think it's a significant policy shift because the central bank is just like the market or any other commentator, where they have to be data dependent and they have to move their thinking based on how things are progressing. And we've seen most other central banks around the world, across the developed world, move to become a little bit more hawkish and looking to either remove policy accommodation, which was very accommodative over the coronavirus pandemic, to remove some of that accommodation, or even to tighten interest rates, as we've seen across some central banks around the world. And the RBA is just responding to that. I always thought that the yield curve target that they made pigeonholed them a little bit. It can be a little bit difficult to explain, and it always meant that at some stage you would either have to get rid of the yield curve target, or you would have to move to potentially to target a shorter dated bond. Instead of targeting a 3-year bond, you'd have to target a 2-year bond or something like that. So it is a little bit of a complex policy, and probably why the other major central banks chose not to adopt a yield curve target, just going down the path of doing quantitative easing or rate cuts.
Deanna, we've got house prices certainly they're on the way up again, and this is often one of the things that the Reserve Bank has to weigh up in its decision making. Now, why don't they, and of course it's out of the hands of the RBA, but why doesn't the administration do something to further reform negative gearing, or maybe scrap it altogether to get them out of the mire that this actually creates, or should I say the headache it creates for the central bank there?
Well, that was attempted to be done in our federal election, which was a few years ago. The Labor Party went in with a policy to try and scrap negative gearing, capital gains tax discount, and they didn't perform very well in the polls. And that's when the Liberal Party was not forecast to win, but they actually did win that election, because at the end of the day, I think that a lot of households are positively impacted by housing market movements here in Australia, because it's, obviously reflected in a lot of superannuation balances and in a lot of investments. So at the end of the day, not many people want to see the value of their home falling, which I think why it wasn't a very popular policy here in Australia. I don't see them doing any changes to those taxation impacts on the housing market. We've already seen some changes by APRA to serviceability, and that may continue.
Deanna, I have two questions in one. How does this decision today do anything to repair the credibility issue that a lot of people were saying when it comes to the RBA? How are they going to do communication moving forward? And does today's decision have global implications for central banks out there?
Well, just on the second point, I think maybe other central banks will look at the yield curve target and see some of the issues that have arisen for the RBA in terms of doing a yield curve target, see some of the difficulties and maybe not want to go down that path. Japan still has a yield curve target in place, but I think that their market is a little bit different to something like the US or in Europe. And in terms of the first point, their credibility, they're putting out they're doing a press conference. I saw in the statement at 4 o'clock today. So maybe Phil Lowe will try and explain the thinking that the RBA was going through. It is very strange that they decided to not make a decision about this last week, or not to come out with some kind of press commentary about this last week. But in the long term, I don't think it dents the RBA's credibility here in Australia.